Here's the default rule you should hear in your head on every EA exam question. All income is taxable, unless a specific law excludes it. So you start by assuming it's in gross income. Then you go hunting for an exclusion. If you find one, it never becomes income in the first place. That's a huge deal, because exclusions can keep you out of phase-outs entirely. Exclusions and deductions sound similar, but they behave very differently. An exclusion means it's not in gross income at all. A deduction means the income is in and you subtract later. And deductions and credits often phase out as income rises. Exclusions usually don't care how rich the taxpayer is. On the exam, that's the trap. High income can kill deductions, but not a true exclusion. Think about Marcus, the superstar with millions of taxable income. Lots of deductions and credits get phased out for him, but he gets a $95,000 settlement for physical injuries. That's excluded. It stays excluded no matter how high his income is, and typically it's not even reported. The exam loves this contrast. Exclusions are about the type of income, not the taxpayer's bracket. Now, lock in the calculation pipeline. Start with gross income, wages, business income, interest, dividends, gains, fringe benefits, all of it, unless excluded. Subtract for AGI adjustments to get AGI, then subtract either itemized deductions or the standard deduction to get taxable income. Apply the tax rates to get gross tax, then subtract credits to get net tax or a refund. Earned versus unearned income matters because of payroll taxes. Earned income is pay for services, wages, and self-employment income, and it's generally hit with Social Security and Medicare taxes. Unearned income is things like interest and dividends, and it's usually not subject to FICA or self-employment tax. EA exam tip: income tax and payroll tax are separate calculations with different bases. 2 quick gotchas they test. First, workers' compensation for job-related injuries is excluded from income. It's not wages. Second, disability benefits can be partly taxable depending on who paid the premiums. If the employer paid 80% of the premiums with pre-tax dollars, then 80% of the benefits are taxable. The exam loves partial taxability questions because they're pure mechanics. Supplemental wages are compensation paid to an employee in addition to their regular pay. Which type of income would not be classified as supplemental wages? The choices include sick pay, workers' compensation, holiday pay, and vacation pay. Think about which one isn't treated as wage income at all. Think about it. The correct answer is workers' compensation. Workers' comp for a job-related injury is generally excluded from income, and it's not treated as wages, so it's not supplemental wages either. A tempting wrong choice is sick pay, because it feels like a benefit. But sick pay is still wage-type compensation and can be treated as supplemental wages. Marissa is paid her full salary while on jury duty, but her employer requires her to turn over the jury duty fees to the employer. She receives $375 of jury duty pay and remits it back. How should this be reported? The options include an adjustment to income, offsetting wages, an itemized deduction, or no deduction. Think about it. The correct answer is, she can deduct the remitted jury duty pay as an adjustment to income. The jury pay is included in income, but when she's required to turn it over to her employer, she gets an above-the-line deduction on Schedule 1. The tempting wrong answer is offsetting wages, but you don't net it against W-2 wages. You take the adjustment.